Welcome to FX Street. It's Thursday, July 30th, 2009. Welcome back, one and all. So glad that you could join us. At any time, please let me know if the audio or video does not come through. I'll be sure to make an adjustment as fast as possible. But I want to thank you all very much for coming. Thank you. Very special thanks to FX Street as well for hosting this webinar. Today we have a very fun topic. It's probably one of my favorite things to talk about, technical analysis, specifically chart reading basics. Now, this is a process that I've used for years. It's changed from time to time, but the essential process is very simple, and it's drawing trend lines and drawing Fibonacci lines to establish the trend and the tone of the market. By the tone, meaning is a market in a range-bound or trending climate. Range-bound climate is when the market does not make new highs or new lows, but it stays in range, and we can buy low, sell high. On the other hand, a trending market condition is a market, now we've seen this market lately, where the market tends to make new highs or new lows over a significant period of time, and either the buyers are making money or the sellers are making money. Now, regardless of the tone of the market, whether it's range-bound or trending or the actual direction of the market, the process remains the same. I like to start with trend lines being support and resistance lines. And to do so, we should look at the direction of the market. Now, we should see in front of us a chart. The symbol is YM. YM is a future symbol for the Dow Jones Industrial Average. And we're going to get to foreign exchange currency pairs as well in just a moment. But the Dow Jones Industrial Average, especially considering the fact that we're in the midst of earnings season in the U.S., the Dow Jones Industrial Average has a very strong correlation to certain currencies, so it can certainly be a very helpful asset. With that said, without drawing any trend lines, I'd like to take a step back, and step number one is just to identify, is the market moving higher or lower? When there's a trend. If it's a range-bound market, it's a different story. It's actually very easy as well, though. But in this case, we can see over a certain period of time, since about late February, early March this year, the market has consistently moved to the upside. So what I'd like to do is start with support levels. Support levels represent the floor of the market, where we expect the buyers to return to and a good place to buy. Now, to draw support, we always start with support in an uptrending market. If the market were downtrending, we would start with the resistance. However, given that we're uptrending, start with the support, take the absolute lowest low. This looks to be around 64.57 lows of March 6th of this year. Draw the uptrending support line to the next most significant lows. Let the market go up and then let it pull back. The next most significant low I see is July 13th, 2009, not too long ago. Now, from this point moving forward, you can zoom in just a hair, we can see the uptrending support line now emerges. If the market were to pull back today, the proper place to buy would be around 8,200. I don't think it's going to get there today, considering the futures at 91.49 and charging higher. Now, the rule of thumb is oftentimes, it's not something that's in concrete, but oftentimes support and resistance levels will emerge in a parallel fashion. So the next step is to draw a resistance line connecting significant highs. So a number of different significant highs, but it's an extra source of confirmation when this resistance falls in a parallel fashion to the support. These support and resistance lines simply explain the angle of which the buyers overwhelm or have an advantage over the sellers. If you can imagine, if we were to break down all the buyers and sellers, count all the buyers and count all the sellers and come up with a ratio, I'm guessing the ratio maybe would be 2 to 1 or 3 to 1. There would be 3 buyers for every 1 seller. And if that ratio of buyers to sellers remains consistent, this trend line should continue in its upward angle. Now, why do we draw these trend lines? I didn't know that the next lowest low was going to occur on July 13th. There's no trade to be placed yet. However, the next time, if and when the market pulls back to our support level, and if it comes very close or touches our support level, fails to cross below to a great degree and shows signs of reversal back to the upside, that third test is the actual place where we would buy. We would try to buy as close to support as possible, placing protective stops below support. Now the question may arise, well, what if the future is 91.48, the resistance is projected to be around 94.13? Could I sell short up there? The answer is yes, but the answer is also I really probably would not want to do so. Reason being is that the rule of thumb that we all like to use is a trend is your friend. There are more buyers versus sellers, and even though if and when the market hits a 9,400 level and shows the signs of reversal, True, the market may in fact reverse from 94 down to 82.50. That would be a fantastic trade. But we don't know if the market is going to stop at 94 or continue to 10,400, 11,400, or maybe much higher. Now, so I only want to trade with a trend when there's a trending market condition. The market's making higher highs. Another thing to consider is what I like to call swing highs or swing lows. Take a look at the significant highs and lows the market was able to achieve. I like to draw horizontal lines the same way. Oftentimes, and the reason why we do this is oftentimes former resistance being the ceiling, becomes our new support. Now, it's not a very clean pattern, but it did happen, where the market consolidated. You see the market's kind of going up at a very, very nice clip. From early March until about early April. For 1 month, the market, the Dow Jones Special Average, hit lows of 6,500 up to highs of 80. So basically, 1,500 points the market achieved in almost exactly 1 calendar month. Okay? From beginning of March to beginning of April. Now, from the beginning of April to the beginning of May, the Dow Jones Industrial Average really did not make higher highs. It did a little bit, but it pulled back. This shows us a little bit of a head and shoulders pattern, actually, if you really were to zoom in on this chart. But nevertheless, the market found some sort of resistance, some sort of trouble at 8,000. Now, imagine from the lows of 6,500, and I always like to try to picture what the buyers and sellers have done over a period of time. From early March to early April, for 1 month, imagine there's a room full of traders. There's 50 buyers and there's 50 sellers. Half the buyers, half the sellers. Well, the buyers, any buyer that bought in the beginning of March and held the stock market long, held that trade open, probably made money. Now, of course, there's those that, maybe bought too much or moved their stops too close, but the majority of the buyers in the month of March made money. That's what I'm guessing. The majority of the sellers, those who sold short, probably lost money. It's true, you're able to sometimes make money when the market comes down in an uptrending market, but I'm guessing that a greater amount of sorts, those who sold short, betting that the market's going to go down, probably lost money. However, from the beginning of April to the beginning of May, now that ratio changes. Now I would say about half the buyers made money, half lost. Half the sellers made money and half lost. Why? Because the market stopped going up. Range-bound market. So some buyers made money, some sellers made money. The ratio from 3 to 1 probably turned back to 1 to 1. Okay, so we went from imagine a room full of traders, there's 100 traders in a room. In the month of March, 7 out of 10 traders were buying, 3 out of 10 traders were shorts. Now, in the month of April, it's about 50-50. Well, that level, that technical level that we hit, that represented that change of trend, the change of tone, is around 8,000. That's our resistance. It's very important because once we broke out to new highs above 8,200, we went to around 8,800, pulled back. But notice, remember this resistance line was established early April. Miraculously, mid-July, the market retested this 8,000 level, almost exactly the large round figure, 8,000, and found new support. Reason being is that all those that bought from April through July, well, all those buyers have a higher cost basis. All those shorts probably lost money. Therefore, all those shorts that lost money, they're probably going to want to buy to cover the shorts. And those who made money, well, they probably have a greater deal of money in their accounts. The next step is that next big level on 87, 8,800. My suspicion is, and the reason I'm bringing this all up is because if the market pulls back to 8,800, 8,900, I think this could be our next support level. That's the next place I'm going to go long. Now, adding a further dimension to this, let's add in Fibonacci levels. Now, Fibonacci levels, it's a tool most of you are probably very familiar with it, but the review is always good. Fibonacci is a very, very helpful tool because it measures the probable new supports or probable new resistance that will emerge based on the Fibonacci percentages. There are a number of Fibonacci percentages of 38.2%, 50, 61.8%, and less commonly used 23.6 and 78.6. Now, those please, if you'd like to know those Fibonacci levels, I'd be more than happy to type them in the chat. But those levels are used by all. These are the magic Fibonacci levels. Well, from the lowest lows, in an uptrending market, we always start at the low, beginning of March. Draw your Fibonacci levels from the lowest low in an uptrending market and draw them up to our highest high. So from early March to early June, the market went from, what, 6,500 to around 8,800. Pulling back, now we see the retracements, and the first line is a 23.6% retracement level. What does that mean? You measure this entire move up from 6,500 to 8,800, subtract 23.6% of that. Quick, everybody grab the calculator. Fibonacci tool tells us that would project support may emerge around 8,300. Now, we don't know where support's going to emerge, but the probability is, the rule of Fibonacci is not that we know that it's going to land at 23.6. The probability is it's going to land at one of these Fibonacci levels. Which one? Well, oftentimes they intersect with our normal trend lines. But we didn't know this uptrending diagonal trend line would exist. However, we did know that our former resistance at 8,000 could become new supports. Well, the 38.2% Fibonacci level didn't come to 8,000. It's, my chart shows, 79.55. Only 45 points difference between where the market actually, let's take the actual lowest low, 80.14, 80.14. 80.14 is the lowest low. That's about 50 points in the Dow Jones Industrial Average. That's half a day's trading. That's not a big deal. That's pretty accurate. When we see trend lines, especially these horizontal former highs and former lows, match up or intersect to come very close to Fibonacci lines, I love it. If it also intersects with this uptrending support line, I really, really like it. So those were two different technical pieces of information that told us be on the lookout for possible support at 8,000. 8,000 also represents a large round figure, and that certainly plays a very important role. Now, moving higher, where do we think the market's going to go? Well, we pulled back. The Fibonacci rule tells us that we believe the market's going to continue an uptrend. An uptrending market looks like a flight of stairs. We go up a lot and we pull back a little. We go up a lot more, we pull back a little. Well, remember we subtracted 23.6% of this former trend to indicate where the 23.6% Fibonacci retracement level will be, 8,300 roughly. Well, take that same 23.6% Fibonacci retracement amount, and instead of subtracting it from the top, add it to the top. That would give us a projected price target around 9,400. 9,400 also happens to intersect, coincidentally, or maybe not coincidentally, with our uptrending projected resistance. Why is this line important? It connects significant highs, but it's also parallel to our support level. So point being, after we've done this very, very quick, simple analysis, I would say, without any other information at our fingertips, I think the market has a very good chance, the stock market, to continue up to the 9,400 level. 9,500 is a big level, by the way. 9,400, and it may find resistance there. So if we have stock market trades that were long, well, I'd like to try to hold on to them. I don't want to move the stocks up too much. I want to hold on to them, and I don't want to take two profits too quickly. Of course, if market conditions change, if we start to see reversal patterns, that's a different story. But given the current information, given the trend is up, 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 I would like to hold on because I think we're at 91.81 right now. I think we could see 94, 9,500. Now, Boyke made a great point. I'm sorry, not Boyke. Abel made a great point. Boyke did as well. That it did not exactly hit the 38.2% Fibonacci level. This is true. If I drew in about 10.5 seconds these very simple Fibonacci lines, I'm certainly sure other traders also drew the same Fibonacci lines. Now, there is a little bit of a self-fulfilling prophecy when we talk about technical analysis. I'm sure I'm not the only one who drew the Fibonacci lines and these trend lines in this fashion. It's probably one of the more common techniques used. I like it because I like to see where the other buyers and sellers anticipate support and resistance may emerge. So the market did not hit 8,000. It hit 80.14. It did not hit our 38.2% Fibonacci level, which stands around 79, 79.50. This is true. I expect that to happen. If there's a lot of other traders anticipating that the market's going to hit 8,000, I may place my buy order at 8,050. You may place your buy order at 8,025. Well, all those anticipatory buy orders what that will do, what those orders will do, is create a little bit of a cushion on top of the support. Now, in a perfect world, the market would come all the way exactly to the support line and then turn around and bounce back up. Well, it's not a perfect world. Trading really never is. But with that said, these extra buy orders, and maybe the shorts out there who also saw, hey, I'm short the stock market. I was lucky enough to get in a short around 8,800. We're now down near 8,000, but guess what? And I see the Fibonacci levels at 38.2% Fibonacci levels, just a little bit below 8,000, but I know 8,000 is a big, round, large figure. I see that there's a Fibonacci level there. I see there's a horizontal line, which did represent resistance to 8,000. That could represent your support. So I'm going to cover my shorts, not at 8,000. I'm going to cover them at 8,050. So with that said, there sometimes is a little bit of buffer. When I look at these Fibonacci lines, I like to imagine maybe a little bit of a pillow sitting on top of the Fibonacci line. We may come all the way down the Fibonacci line. We may come a little bit below. Sometimes we may not even touch it. That is the market. That's the imperfect world of technical analysis and the imperfect world of trading markets. But all the same, I still think it adds a tremendous amount of value. Now, great comment. If I heard that if it retraced to 23.6, it'll move higher than it retraced to 61.8%. It's such a fantastic question. It's a theory of mine that I've been very, very curious about as well. Now, I've done a tremendous amount of back testing. I'll tell you up front, I have not found conclusive evidence to one direction or the other, and I'll explain what I'm talking about for those that I may have confused. There's a certain train of thought, and for those of you that have an opinion, please feel free to type it in. I'd love to hear. There's a certain train of thought that says, hey, the market rallied all the way up, and we pulled back to the 23.6% Fibonacci level. And because it only hit the 23.6% Fibonacci level, because it's not hit the 38.2, the 50, or anything lower than that, because the market found support that much faster, the buyers chased the market up, the buyers are waiting right below us. I think now the subsequent breakout is going to be much, much higher. And I'll explain this, and I'll try to explain this in very simple terms. Imagine we're talking about the housing market. Remember those days when the housing market was good, when you bought a house and it actually went up in value? The good old days. Well, imagine we want to move to, I don't know, London, Southern California, New York City, somewhere where the housing market is notoriously very strong. Well, maybe not Southern California. We want to move to New York City, and what's the average asking price for an apartment in New York City? I don't know, $500,000 maybe. The prices never go down there. Well, I decide to move to New York City, and I say, well, what's the average price for a one-bedroom apartment? $500,000, what the realtor says. I say to myself, that's a bit much. I only want to spend $400,000, so I'm going to wait. Well, the market pulls back to $450,000. It doesn't come down to my ideal price, $400,000. It comes down to $450,000 and then shoots up higher, moves to $600,000, $700,000. Well, I say now I'm going to wait for a pullback. Let's say it goes up to $700,000. I'm not going to wait for what $500,000 to $400,000 would be a 20% pullback. I'm not going to wait for a 20% pullback. I'm only going to wait for a 10% pullback. So it goes to $700,000. Well, from 5 to 7 is what, 200,000 minus 10%, 20,000. So I'm not going to buy 600,000. I'm going to buy 680,000. That anticipation, that activity, that behavior, that I am not waiting for a deep pullback, that I am very eager to buy, I'm an eager buyer, means I'm willing to pay more. That rationale explains why if the market does not pull back a lot, when we look at the charts, don't think of the Dow Jones Special Average. Think of this as a studio apartment in the Lower East Side asking $500,000 and that we know that the market's not going to pull back to 400, and we know it's not going to pull back to 300. So from 500, I'm hoping it pulls back to 480 because I know the market's very strong. I know there's other buyers out there. There's always buyers out there, and in popular real estate cities, I'm willing to pay more. That rationale explains why the market did not pull back a lot, and that rationale explains why the market should go that much higher. Well, that's one side of the coin. The other side of the coin is I say to myself, well, let's say the market pulls back a lot. Let's say we did not pull back to the 38.2%. Thank you. I just made that up right now. I was hoping it was going to make sense. Let's say the market does not pull back to 38.2%. Let's say it pulls back to the 50% or 61.8% or even more. If and when the market subsequently breaks out to new highs, the other side of the coin, well, we could say, well, maybe because the market pulled back so much deeper, more traders were able to get involved. more buyers are able to get involved. The market goes up to 500,000 and pulls all the way back down to 300,000, and then everybody buys. And everybody that sold short a house, I don't know if it's, well, it is possible now, they have derivatives. Anyone who's betting against the markets, at the end of the day, ultimately lost money betting that the market was going to go down. A greater amount of traders or buyers got involved, and then when the market makes a new high, those traders have a better cost basis. Their average price of the home is not 500,000, it's maybe 350. That other rationale indicates or dictates that, well, the market should go up a lot. It should go up a lot more because we have a lower cost basis. Maybe we have more capital to work with. We have more margin. Think of this in terms of a $300 mini account. If I buy, I'm just going to make up numbers. Let's say I buy the euro dollar at 130 and it goes up to 140. And then it pulls back to 138. Well, so I buy at 138 and then it goes back up to 140 and now 142. Well, how much should I make? I've made 400 pips. I bought at 138. Right now it's at 142. I've made 400 pips. That's 400 additional pips of margin. That's 400 additional pips of profit. That means maybe I can afford one more mini lot or two more mini lots, whatever it may be. However, on the other side, let's say the market moves from 130 to 140 and then pulls back to 132. Then I buy at 132 and then the market moves it to 142. Now I don't have 400 pips of profit. I have 1,000 pips of profit. Instead of buying one mini lot, now I can buy 3 mini lots. Instead of having a little extra profit, I have a lot of extra profit. Therefore, the market should go up that much higher because the buyers have been making money for a longer period of time. The buyers have made more money. Now, if you were to ask me, and I would say that I did a real extensive amount of back testing through TradeStation, those type of applications, and I actually, programmed in the code. I said, okay, show me every single time. I wish I still had it. I have to look at it. I have the code somewhere. Show me every single time that the market pulled back to the 23.6% Fibonacci level. What was the average push-up? How much was the average breakout? And then show me the average breakout once we hit the 78.6. I did not find a specific correlation. Maybe my code was too specific. Maybe my code was not specific enough, but it was inconclusive. But I'll tell you my personal opinion. My personal opinion is that I think that if the market pulls back and has a more shallow pullback, if it only pulls back to the 23.6 or the 38.2, I think that will lead to an ultimately larger move to the upside. I think the market goes up more if we have a shallow pullback. My thinking is that the market were to pull back all the way back to 61.8 or 78.6, well, then the market probably, it shows that there is not that same ratio of buyers and sellers. If the market only pulls back to 38.2%, it means out of every 10 traders, 7 are buyers, or 6.2 are buyers, and 2.8 are sellers. That's what I think. That's my own personal opinion. Blakey says this shows lagging indicators are not necessary. Well, the fact of the matter is all indicators, all technical indicators, I mean, this is what I was told, by definition are lagging indicators. Because all indicators basically measure price over time in the past. They project, they can anticipate where the market may go in the future, but they all measure past indicators. Now, what is a forward-looking indicator? Not a lagging, but what is a leading indicator? We tend to talk about fundamental data. We have non-farm payrolls the first Friday every month in the U.S., the employment number. But every week we have jobless claims. Now, some fundamental economists will say if the jobless claims say this, this, and this every week, that indicates that we think the non-farm payrolls will be that, and that. That I consider more of a leading indicator. Pound Swissy? Absolutely. I've prepared a bunch of other charts. If there's any specific currency pairs that you'd like to see, please do not be shy. Chat them in, and I'll do my best. I'm very long-winded today for some reason. I'll do my best to get to all of them. But let's start with the Pound Swissy. Enough with the Dow Jones Special Average. So point being, I think the Dow Jones Special Average chart looks very good. Now, to just add one more thing with the Dow Jones Special Average, keep in mind the Dow's had a tremendous move, but we're in the midst of July earnings season. Come August, come September, the market tends to be very, very quiet, at least a little bit more range-bound. Therefore, I would not expect this current strength to continue. All right, where do I anticipate the next target near resistance line? We anticipate the next move for the Dow Jones Special Average. To go back to the Dow really quickly, the 23.6% Fibonacci projection level and uptrending resistance tells us around 9,400. That is given the information that we have at the moment. I would say around 9,400. Makes sense because from my memory, from my days of day trading, I remember 9,500 was a big level. 94 to 9,500. Question is, what do you think about Andrew's Pitchfork? I heard most hedge funds use it. I personally have not used it. Not to say anything negative about it at all. It's just, unfortunately, there's a limited amount of hours in every trading day. I wish I had more time. As is, I'm running late on my schedule with what I'd like to talk about today. But we're all going to talk about support and resistance in Fibonacci. It's really the basic elements of what I like to use in technical analysis. If you're curious to see what the next step is, as I draw my trend lines in the pound, this is euro dollar. I want pound Swissy. If I were to draw, if I were to have more time and continue after support and resistance, after Fibonacci lines, I would probably choose to look at an oscillator. An oscillator, meaning the RSI, MACD, Bollinger Band, some things that we talk about, quite often. At any rate, pound Swissy, a really, really nice chart. Draw your support line. I'm disregarding the lowest low. It's okay to do that once in a while. We don't have to disregard it. We want to, be a perfectionist. We do not have to disregard it. So connecting the lowest low on the pound Swissy chart that we've seen in quite a long time. December 29th lows, Happy New Year, 151.20. Connect that line to the most significant low, and that happens to be 158.46, March 10th. Okay, now the next step is to say, well, our projected support lies around 173.40. Right now we're 180.16, so we have some room to wait. Now, connect the most significant highs to establish a resistance. We said sometimes they're parallel, sometimes they're not. I'm trying to find if I can find parallel lines, a resistance line that looks parallel. There is the possibility. It's a little early to tell which line I drew more accurately. Oftentimes you'll see contradictory information. One resistance line tells us around 82.69. Another resistance line tells us 83.35. But in an uptrending market, the most important aspect or the most important line is support. In a downtrending market, the most important line is resistance. Why? Because support tells us where to buy. Support for pound Swissy, long-term traders, 173.30 roughly. Now the next step, let's draw some Fibonacci lines. Take the Fibonacci's from the lowest low, 151.20, December 29th, and drag those Fibonacci levels to the next most significant high. Those were the highs of February 10th. Pull back to the lowest low, 61.8% Fibonacci level. We got just a little bit below that. It's not a perfect sign. It's lows of March 10th. That happens to be, and I found oftentimes when we're drawing our uptrending support line, the second low, what actually allows us to draw the support line, should come very, very close to Fibonacci level. That tends to be very, very helpful. Now, the market moved up. We broke out to new highs, and this is what I love to see. We're taking a look again at the next lowest low, 158.46, roughly March 10th. Rested on a 61.8% Fibonacci level, not exactly, but pretty close. Long candlestick wicks, a little extra confirmation. We broke out, but we have to break out and wait for new highs. We eventually did hit new highs. We traded above that highest high June 2nd, holding on to the trade. Well, the suspected resistance, not by these trend lines. We didn't know where the trend lines were going to emerge until the highest high was established, but this came very, very close to the 23.6% Fibonacci level, which is projected on 180.43, with the highest high, 181.13, about 60 pips. Not too bad, considering it's a pound Swissy. Now, a little trick I learned is you take the same Fibonacci length and you drag it up to what we know as the next support level, the next lowest low, and look at here. This is really cool. I'll do it again. Remember, this is the same Fibonacci level. I haven't changed the length. Grab it in the middle. You don't have to change the length. Take the lowest low down here and connect that, bring it up to the next lowest low, and notice how our highest high came very close to the 100% level. This means from the lows of December to the highs of February, the lows give you the actual numbers, 151 roughly to 174. How much is that? Around 2,100, 2,200 points, 2,000 points roughly. The lowest low to the highest, next highest high was 2,000 points. the next lowest low, to the next highest high was also about 2,000 points. But let's readjust our Fibonacci levels as follows. To the next highest high, and if the pound Swissy breaks above these highs of 181.13, let's say we're lucky enough to already be long the June 24th highs, well, I have to do a little bit of housekeeping here. 183, we'll call it 189. There we go. And this tells us where is our price target for the pound Swissy? 23.6%, which is only the first Fibonacci level, which means our minimum price target is 186.30. So my point being is that if we break above these 181 highs, I think it's feasible and very likely we go to 186. Hold on. Question is, do you usually try to draw a resistance line parallel support? Abel, it's a great question. I do try to. It's not necessary, but when it does happen, it makes me feel a lot better because it shows me that I'm not the only one that drew this Fibonacci, this trend line. It shows me that you know, the ratio between buyers and sellers is consistent among support and resistance. It's nice to see. Makes me feel better. Let's get to some other currency pair while we still have some time. We have time. Cable yen. Now, this is just simple technical analysis, and it is possible. I think it is certainly very, very possible to trade with this and no other technical analysis tools. By the way, you should see a cable yen chart right now. Please let me know if you do not. I'll be more than happy to refresh. But some traders they'll use everything from Elliott wave to candlestick patterns, RSI, you name it. I think this is a very, very simple and very effective way to trade. If you're not in the habit of waiting for 1,000 pip pullbacks, this approach, this process also does apply to shorter term charts. 4-hour charts are great for swing traders. Swing traders are traders that hold trades for anywhere from several hours to several days. A long-term trader, we hold trades for several days to several months, maybe even more than that. Day traders, we hold trades for a few minutes, maybe a few hours at a time. Okay, so that made a lot of sense. We bought at 143 and the market charged up higher, so it was a nice trade. Let's draw Fibonacci levels, and I know the market broke below. I'm not ignoring that. I certainly want to talk about that. But draw Fibonacci lines from the lowest low up to the next most significant high. Notice this, almost to the button, almost exactly to the 38.2% Fibonacci level. Then we went back to the upside, eventually breaking a double top high to new highs. Where did we land? Well, it's above the 23.6% Fibonacci level, but notice the 23.6% Fibonacci level. Notice this. Anybody can tell me what this pattern looks a lot like? I'll give you a hint. This looks like the first shoulder. The first shoulder, what could be a significant head and shoulders pattern because it's on the daily chart. First shoulder high, then the head at the top, and then the second shoulder, which a rule of thumb is should come very close to the first shoulder, which it did, pretty close. Therefore, it does not bother me that head went much above the 23.6% and actually went to the 38.2% Fibonacci projection level because the market gave us an even more significant indication. Head and shoulders is a very bearish signal, and typically we see the market breaks in the opposite direction of the head. The head's at the top. So this breakdown, when do we know it's going to break down? Draw that shoulder line connecting the significant lows. That's around 154.70. And that we broke below 154.70, going ultimately down to 146.74. Not too bad. The question is, how can he tell us a significant low? Well, there's a little bit of poetic license. It's a fantastic question. There's a little bit of poetic license that always goes into chart reading. Your significant low may not be my significant low. But I'll zoom out on a chart and I'll show you what I'm looking at. I'm looking at a cable yen chart. Now I zoomed out going back to April of 08. The market went down the line. Now, if I were to ask you, what is the lowest low in this chart? You would ultimately tell me the same exact price that we identified, 118.80. The market didn't go any lower. Now, to answer your question, how can I tell this is a significant low? The answer is, by looking at the chart that I'm looking at, I'm going to identify the most significant low. Now, I'm going to zoom out on a cable yen chart. Now, let's look over here. I zoomed in a lot. Now, it's only going back to the beginning of April. This most significant low is not the lowest low. So what I'll always do is zoom out and then zoom out again until I find the most significant low. Now, the next most significant low, how do I know what the next most significant low is? Well, let's pretend we didn't know the market was going to fall here. Let's draw the line to the next most significant low. We can also draw the line this way. But if and when the market breaks below the supports, I have I'm in the habit of adjusting the trend line, or we just draw another trend line. It's okay to do so. Again, there's a little bit of artistic license that's put into these, put into drawing trend lines and technical analysis overall. We can connect most significant lows as follows as well. It's okay to do so. Oftentimes, you will see multiple support lines. And in a perfect world, we'll have one support line that the market always comes down to, and that always tests and never falls below, and always gives us the greatest spot to get in. That's in an ideal world. Sometimes it happens. But unfortunately, Mr. Cable Yen is not giving us one of those times. It does look like a Fibonacci fan. Those are Fibonacci percentages drawn in a diagonal level. Now, what's really interesting, the rule of thumb also, is that former support, what once acted as our support, now may act as new resistance. Coincidentally, it's a 23.6% Fibonacci level at 159. Coincidentally, it's also a former support, could be new resistance. And coincidentally, it is a neckline of our head and shoulders pattern. So I would tell you at the very, very minimum, 159 and 160 is really, really important. If we break above 160, I think we have a very good chance to revisit 162.57 and much higher. And if we test and fail to break above 160 and go back down, I think we have a very good chance to go much lower. I think that is the proper approach. That's how we should use technical analysis. I don't think technical analysis is something that we can use to say this is absolutely going to happen and that is absolutely not going to happen. I think technical analysis is is a game of probability. If this happens, then that is most likely to happen. If that happens, then this is most likely not going to happen. Talk about, make the comparison to baseball. If I have a baseball team like the New York Yankees or any sports team for that matter, it doesn't matter. If I go out there and spend the most amount of money, if I spend the most money there to get the greatest pitcher and the greatest third baseman and the greatest shortstop, the probability is that team is probably going to go to the championships. If I go out, why? Because we spent a lot of money, and that logically dictates we're probably going to have a lot of really good players. On the other hand, if I go out there and I don't spend a lot of money and I get only rookies and I only get only new guys, then, well, the probability is I'm probably not going to go to the championships. Now, because the market broke below the support level, 160, roughly the large round figure, and because it's a neckline of that former head and shoulders, and, there's no other reason because it's a big level, it's also 23.6% Fibonacci projection level. Don't forget about that. The probability is that the market is going to have a hard time at 160. If you see a couple daily candlesticks close above 160, that's a very bullish sign. That's a very good sign. I think the use and the advantage of technical analysis is to create scenarios. If this happens, the probability is that's going to happen. If that happens, then that's not going to happen. We have a request for EuroCAD, so I will look at it. Does that make any sense? I really, really hope it does. It's sort of an approach that I've developed over time, and whoops, that's PoundCAD, and changed. I don't think there are absolutes really in anything. S&P 500 about to hit 1,000. That's a large round figure. And that way, I like to use these, to be a little bit general in a sense, because then if I'm wrong, my feelings aren't hurt. All right, now I see the market's trending down. What I'm doing is I'm zooming out, and I'm trying to find the most significant high, because we said we want to draw support and resistance levels, most significant highs and lows. Well, the EuroCAD, we zoomed out going back to April 2008. And the most significant high I see is the highest high, December of last year, around 175. Draw that resistance down to the next most significant high, and that would be around 169, 170. What day is that? That's third week in March 18th. Let's zoom in. All right. Well, we can see that resistance level. Remember, downtrending markets, we start with a resistance. In uptrending markets, we start with support. And resistance line is most important because it tells us where to sell short. Well, the next time the market came up, it crossed above this resistance line. Not always going to be perfect. We hit a high of 163.23 on June 30th. The next most significant high was 163.22. So 163.23, June 30th, 163.22, July 9th. That is a difference of around 10 calendar days, about 2 weeks, and a double top, and I'll zoom in, the double top that emerged, the difference between the highest high was 1 pip. That is not too bad. True, we did cross above the resistance level temporarily. A couple daily candlesticks did get above there. But because we had such a clear sign of a double top pattern, I really like this area to sell short. Fibonacci may ask, take the most highest high. Remember, in the downtrending market, we start always at top 175 highs, late December. Draw it down to the most significant low. Those are the lowest lows of 156.40 on February 1st. The market rallied up to the 61.8% Fibonacci level. It cleared that. It almost got to the 78.6% Fibonacci level. Well, it's not a perfect world. Sometimes Fibonacci gives us a clear indication. Sometimes it does not. The one thing I would say in defense of my friend Fibonacci is that the Euro-CAD is certainly not one of the more actively traded currency pairs. I think, and in fact, I know that if you plot Fibonacci on long-term charts, if you look at the euro-dollar or the pound-dollar, you're going to find Fibonacci works a lot more accurately. Euro-CAD, well, there's still trillions and trillions of dollars that goes through the euro and the CAD. It's not as actively traded, so I would not expect Fibonacci, the trend lines to work maybe as accurately. Now, I don't want to miss this question. Question is, how do you place your stop before the fourth time I broke the trend line after noticing the head shoulders? You would not consider a long position or price it trend the fourth time. Abel, I'm sorry to ignore your question earlier. I believe referring to the cable yen. So again, how would I place my stop? Well, in terms of the head and shoulders, the rule of thumb is the second shoulder should come very, very close to the high of the first shoulder. And so therefore I want to sell short near the high of the first shoulder with stops above that, anticipating the second high, the second shoulder come very, very close. Now, how would I place my stops in terms of the trend lines? Well, the next time, I'd always place my trend lines below support or above resistance, where our trade would have been stopped out. Now, at this point that we hit 160 again, if we find resistance and if the market does not go up anymore, I would wait for the market to show us a reversal, and I'd want to place my protective stops above the trend line, above the 23.6% Fibonacci level, above the neckline of the head and shoulders level, all these significant highs. I want to place my stops above it. But in this particular case, I would not sell short the cable yen under any circumstances. This is not for technical reasons. It's for fundamental reasons. Because my personal belief is because there's a difference in carry trade. There's a greater interest rate in the UK, in the British pound, than there is in Japanese yen. And I think over time, you will see interest rate hikes in the UK, and you will see the Bank of Japan not raise interest rates. My fundamental belief is that over the long term, cable yen will continue to go up. For that reason, I don't want to sell short cable yen under any circumstances for a long-term trade. Carry trade, and I think long-term, fundamentally, I think cable yen goes up. I only like to take those trades where the fundamental story and the technical picture both agree. What is the best for currencies, log or linear scale, Jesper? It's a fantastic question. I don't have an answer for you. I don't have enough experience with the two to give you one or the other. I think that both are certainly very, very useful under different applications. But, for our purposes, for at least my purposes, I try to keep things certainly very, very simple. And this use of trend lines, horizontal and diagonal trend lines, and Fibonacci, I think provides us with a tremendous amount of tools at our disposal to go above and beyond that. Certainly, I think can add a lot of value, but again, not enough hours in the days. I always use law for equities. I'm not sure about currencies. Well, I think, when comparing to equities to currencies, I think it's certainly very, very important to consider the fact that currency markets open 6 days a week, 24 hours a day. Equity markets are not. Equity markets, I think, are a lot more seasonal as well. Equity markets in the U.S. tend to be most active during earnings season. January, then we have February, March, April, May, June, July. So February, April, July, August, September, October. Those are the earnings seasons. Those are the active periods of time. In between those periods of time, we have very quiet markets. Foreign exchange market, not so much, because even though we may be in a very quiet time in September or in March, the Bank of Japan may still talk. The Bank of England may adjust interest rates. Foreign exchange markets certainly a lot more international. So I think there's a lot more consistency with the momentum and the amount of volume that we see. What is your confirmation to go long if it touches support and an uptrend, TJ? Very, very simply, I want to wait for the market to touch or come very, very close to support. Hopefully it'll be a Fibonacci level. I want to wait for it to pull back, come very close to support as it did over here, and that's a 38.2% Fibonacci level. This point over here, April 28th, we hit the 38.2% level, and we hit that, well, we didn't know it was a trend line, but that is the point that we draw our support level, and then we pulled back again. We hit that future support level, and I'm willing to bet it would have been a Meyer Fibonacci level. That is the point I want to look for. What is my favorite chart pattern? I don't know if I could quantify it to just one, but basically what we've done here. What we spoke about for the past 48 minutes or so, I think I have to go. I'll try to squeeze in dollar yen. I think I'm really over time as is. Please let me know if I have to get out of here. Dollar yen, I would say, by the way, is probably one of the most difficult currency pairs to trade on the planet. It's a vehicle that's more used for corporations, hedging their activities between the U.S. and Japan, or another yen crosses between Japan and the Eurozone, etc. But the dollar yen, if you ask, I think a lot of active forex traders, the dollar yen is a very useful currency pair because it explains a very important relationship. The relationship between the dollar and the yen. Both are low yielding currencies. Both currencies represent a flight to safety. So when there's trouble in the Eurozone, and there's a trouble in Australia, and there's trouble in New Zealand, the capital tends to move into the dollar and the yen as of late because they have very low interest rates. They're considered to be a flight to safety. So, certainly that's very, very important. How would I, just to answer your question, could I go over how we trade on intraday basis using a 1 hour chart, Hardy? The exact same method, use a 1 hour chart. Now, I will say that with caveat that I first used, in fact, I'll use a dollar yen as an example while we have a few more seconds. The dollar yen daily chart, I drew my downtrending resistance first, beautiful. From the highest highs we see April 6th to the next highest highs, June 4th, projected resistance where I want to sell short, 96.68. Okay? I drew my support level afterwards, and it came in a very parallel fashion. Usually the dollar yen is not this easy, but it is today. Okay, now let's move to a 1 hour chart. Let's answer some questions. If I were a shorter term trader, here's my 1 hour chart. Now the big blue lines represent our daily chart support and resistance levels. I am going to keep it there. I'm going to leave it there. I want to be aware that the overall trend is to the downside. But the same methodology applies. The lowest lows now, July 13th, connected to the next lowest lows, July 22nd. And miraculously, the dollar yen is behaving very, very nicely lately. 9,400 represents our uptrending support level. It came almost exactly to that. I encourage you to draw the same lines on your own chart afterwards. Look at support and look at resistance, almost exactly the same. Let's zoom in now, one time frame. This is our channel. Let's adjust these lines, make them a little more accurate. This is our channel on our 1 hour chart. 95.57, my buy zone, where I want to buy at the moment, 94.25. 94.25 is where I want to buy. That's how I would use an uptrend. That's how I would use a chart for. That's how I would use basically 1 hour charts to look for trades. Now, with the last time we got there, it was July 29th, yesterday. You may have one trade a day. You may have to wait 2 or 3 trades. I can even go so far as to continue to draw trend lines. Remember, the closer we get in time frame, the less accurate these trend lines tend to be. So I do encourage you to exercise a great deal of caution. A really aggressive trader, 9,500, uptrending support. But I don't even like that. Last question, what causes big rally in stocks? I did not have a chance to see all the news, but I'm guessing there were some corporate earnings that were probably very, very good, or at least better than what was expected. With that said, I'm certainly at my limit of time, but I do want to thank you all very, very much for joining us. A special thanks to FX Street as well, wonderful host. Please see FX Street's calendar because I will be back on with much, much more later on. If you would like to contact me directly, please do not hesitate, www.forexlounge.com. I thank you again very much for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you next time.